Ladies and gentlemen, stop right now. Put your phones down. Look at me. It just happened. In 36 hours, $7 trillion wiped out, gone, evaporated, vanished from the face of the markets. That's bigger than the worst moments of 2008. Bigger than most people can even wrap their heads around. And while the world is panicking, scrolling, blaming, hiding, I'm standing here telling you, this is not the end. This is your beginning. Because history doesn't reward the fearful. It doesn't reward the frozen. It rewards the ones who see the chaos and decide, right here, right now, to become unbreakable. So, if you're tired of watching from the sidelines, if you're done letting fear write your story, then buckle up. Because today we're not just talking about a crash, we're talking about who rises when everything else falls. Let's go. Chaos is the forge. 7 trillion didn't disappear. Weak hands got burned, strong ones get built. Picture this. In the span of just 36 hours, the financial world watched in stunned silence as 7 trillion barred, vanished from the precious metals markets alone. Gold plunged over 12%, silver cratered nearly 36%, platinum and palladium followed in brutal fashion. This wasn't a gentle correction or a weekend dip that everyone saw coming. It was a lightning-fast liquidation event, triggered by over-leveraged positions, hitting margin calls, CME hikes, shifting Fed expectations, and a cascade of forced selling that snowballed into one of the sharpest wealth destructions ever recorded. Billions turned to dust overnight for those riding massive leverage without the stomach or structure to weather the storm. But here's the raw truth most people miss when they stare at red screens and feel the panic rising in their chest. That money didn't evaporate into thin air like some magic trick. It didn't get burned in a fire or stolen by thieves. It transferred. It moved from the hands of the unprepared, the speculative, the emotionally driven, the weak hands, straight into the accounts of those who were positioned differently, who had iron discipline, who understood that markets don't move in straight lines, but in violent cleansing waves. Think about what weak hands really means. These are the people who chase hype, pile in when everything looks unstoppable, gold hitting all-time highs, silver ripping higher on inflation fears, everyone screaming about safe havens and the death of fiat. They load up with borrowed money, options, futures contracts stacked to the moon, convinced the party never ends. Then the music stops. A single catalyst, margin requirements tightening, a surprise nomination, profit-taking from big players. And the whole tower collapses inward. They sell at any price to stop the bleeding, dumping positions en masse, driving prices lower, triggering more margin calls, more selling. It's a self-reinforcing loop of fear and capitulation. That $7 trillion wipeout? It's the market's brutal way of saying, enough. Enough fake strength built on debt and delusion. Enough pretending volatility doesn't exist when things are euphoric. Enough rewarding gamblers while punishing the patient. The forge doesn't ask for permission. It heats up and hammers anything that can't take the pressure. Weak metal bends, cracks, melts away. Strong metal, tempered, alloyed properly, comes out harder, sharper, ready for whatever comes next. Now, flip the perspective. For every seller forced out in panic, there was a buyer stepping in, maybe quietly, maybe aggressively, absorbing that supply at lower levels. Institutions with dry powder, contrarians who've waited years for exactly this kind of dislocation, value hunters who know history rhymes. They don't scream on social media about bargains. They act, they build. While the crowd runs for the exits, these are the ones quietly increasing exposure, averaging down, locking in long-term positions. The crash burns away the noise and leaves only the real players standing. This is where the transformation happens. Chaos strips everything bare. It exposes who was playing a game of musical chairs with leverage and who actually built something durable. Cash reserves, risk management, psychological fortitude. The weak hands get burned because they treated markets like a casino, betting on momentum without respect for the downside. The strong ones get forged because they've internalized the hardest lesson. Markets reward resilience, not hope. Look back at every major drawdown in history. 2008, 2020, the dot-com bust, even smaller corrections. The pattern repeats. Massive wealth destruction on one side, Massive opportunity creation on the other. The people who emerge wealthier aren't the ones who avoided the pain entirely. They're the ones who survived it and used it. They didn't freeze when everyone else sold. They didn't chase when everyone else bought blindly. They stayed disciplined through the storm, and when the forge cooled, they were the ones left standing taller. Right now, in the aftermath of this 36-hour bloodbath, the same dynamic is playing out live. The weak have been purged. The over-leveraged are gone or crippled. The market cap in precious metals contracted violently. But the underlying fundamentals, supply constraints, industrial demand, geopolitical uncertainty, haven't vanished. If anything, the reset makes the setup cleaner for those who understand cycles. Lower prices mean higher future potential returns for the prepared. The forge has done its job. It separated the metal from the dross. This isn't about celebrating destruction. It's about recognizing what destruction reveals. It shows you exactly where weakness lives, in emotions, in overconfidence, in lack of preparation. And it simultaneously shows where strength is born, in clarity, in resolve, in the willingness to stand apart when the herd panics. $7 trillion didn't disappear to punish the world. It disappeared to rebuild it stronger, one forge participant at a time. The weak got burned. The strong, they're just getting started, emerging from the heat with edges sharpened and foundations solidified, ready for the next phase, whatever it brings. Fear is temporary, discipline is forever. The crowd panics and sells. Legends buy the blood and hold the line. In the raw aftermath of that 36-hour bloodbath, where 7 trillion copper got ripped out of precious metals, gold slamming down over 13%, silver cratering nearly 36%, platinum and palladium getting hammered alongside, the screens turned crimson, notifications exploded, and the herd did what the herd always does. Panicked. Social media flooded with despair posts. Retail accounts got margin called into oblivion. Leveraged traders dumped positions at any price just to stop the bleeding. Fear took over like a virus, spreading through trading floors, home offices, and group chats. People who had been calling themselves diamond hands weeks earlier were suddenly liquidating everything, convinced the bull run was dead. The safe haven narrative shattered, and the world economy on the brink again. That fear felt real, visceral, all-consuming in the moment, heart-pounding, sleep-losing, decision-paralyzing fear. But fear is temporary. It spikes hard and fast in chaos, clouds judgment, forces emotional, sells at the worst possible levels. It whispers that this time it's different, that the crash will never end, that you're smarter to cut losses now than risk more pain tomorrow. History is littered with these moments. The 2008 financial meltdown, when fear made people sell stocks at generational lows. The 2020 COVID plunge, where markets dropped 34% in weeks, and fear had everyone hiding in cash. Even smaller corrections where temporary terror wiped out years of gains for those who couldn't hold. In every single one, the fear passed. The dust settled. Prices recovered, often stronger than before. The people who sold in terror locked in permanent losses. The ones who stayed calm, who stuck to their process, who refused to let emotion override logic. They captured the rebound, compounded their edges, and came out transformed. Discipline, though, that's forever. Discipline isn't flashy. It doesn't scream on Twitter or go viral in motivational reels. It's quiet, consistent, almost boring in its repetition. It's the decision made long before the crash hits. Set your risk parameters, size positions properly, build cash reserves for exactly these dislocations, define your entry and exit rules based on data and strategy, not headlines or gut feelings. Discipline is averaging in when others average out, holding through drawdowns because your thesis hasn't broken, refusing to chase euphoria or flee capitulation. It's the mental muscle built over years of sticking to the plan when motivation fades, when the market tests your conviction, when everyone else is losing their minds. Look at what happened in this wipeout. The crowd, driven by fear, sold en masse. Over-leveraged specs who rode the parabolic run-up on borrowed money got forced out first, their margin calls turning into cascading liquidations that fueled the drop. Emotional retail investors followed, dumping physical holdings or closing futures at massive losses. That selling pressure created the blood in the streets. Gold breaking below 4,900, Silver crashing under $85, there's entire market caps evaporating overnight. But legends? They didn't flinch. They saw the same red screens and recognized opportunity. Institutions with dry powder, contrarian funds waiting for overextensions, patient accumulators who'd been underweight during the mania, they stepped in. They bought the fear, absorbed the supply, positioned for the inevitable mean reversion or cycle shift. While fear had the masses running for exits, discipline had the prepared quietly building larger stakes at discounted levels. This is the divide that separates survivors from casualties in markets. Fear makes you reactive. Discipline makes you proactive. Fear sells at the bottom because it feels unbearable. Discipline holds because it knows bottoms are where wealth gets transferred. Fear chases narratives until they're exhausted. Discipline follows probabilities, risk-reward setups, and time-tested edges. In precious metals right now, the fundamentals, in supply tightness, central bank demand, geopolitical risks, industrial needs for silver haven't vanished. The crash was a deleveraging event, a purge of excess speculation, not a death knell. Those who let fear dictate sold into the purge. Those anchored in discipline used it to reload, to lower their average cost, to position for whatever comes next, whether rebound, consolidation, or further volatility. The truth is brutal but empowering. Markets don't care about your feelings. They reward behavior. Panic sellers hand their capital to disciplined buyers every cycle. Fear fades when the adrenaline drops, and reality sets back in, often within days or weeks. But the habits of discipline compound forever. Better entries, preserved capital, psychological resilience that strengthens with each test passed. Legends aren't born in calm seas. They're forged when fear grips everyone else and they choose differently. They buy the blood because discipline taught them that's where the asymmetric upside lives. They hold the line because discipline proved over time that breaking it costs more than enduring it. In this crash, as in every major one before, the crowd panicked and sold. The legends bought the blood and held, because fear is temporary, but discipline is forever. This crash 2008 speed, 36 hours versus months of bleed. History's fastest reset rewards the prepared, not the scared. The 2008 financial crisis unfolded like a slow-motion train wreck. It took months. Lehman Brothers collapsed in September, but the real carnage stretched from summer into winter and beyond. The S&P 500 bled over 50% peak to trough across 17 grueling months. Housing prices cratered gradually, credit markets froze incrementally, banks failed one by one in a drawn-out agony. Fear built steadily. First subprime whispers, then Bear Stearns bailout in March, then the full panic in fall. People had time to process, to hedge, to delude themselves that it might turn. The destruction was massive, trillions lost, but it was prolonged, allowing some to adjust, others to exit early, many to average down over time. The bleed gave breathing room, even if it felt endless. Now look at what just happened in precious metals. In Wheaties in 36 hours, seeing stop barely more than a day and a half, stuck 7 trillion scallies, dollars vanished. Gold plunged 12 to 13.6% in brutal sessions, dropping below $4,900 from recent highs near $5,600 or more. Silver imploded 36%, crashing under $85 after parabolic runs to 120 plus. Platinum shed 27%, palladium 21 to about 22%. The combined market cap of these assets erased roughly $5 trillion from gold, $2 trillion from silver, plus hundreds of billions more from the others. This wasn't a multi-month erosion. It was a flash crash-style liquidation event compressed into an insanely short window. Margin calls hit like lightning after CME hikes. Over-leveraged positions got force-sold en masse. A hawkish Fed nomination, Kevin Warsh whispers or confirmation, combined with surging dollar strength, flipped the crowded trade on its head. Algorithms amplified, retail panic followed, and the whole structure collapsed inward faster than anyone could react. Speed changes everything. In 2008, the slow bleed allowed preparation. Some institutions deleveraged gradually. Governments intervened step by step. Investors had weeks to reposition. Here, there was no runway. The drop was so violent, so condensed, that only those already positioned correctly survived intact. Over-leveraged specs who chased the euphoria got wiped out instantly. No time to add collateral or cut partial losses. Emotional holders who weren't truly convicted sold at the absolute worst levels because the velocity left no psychological buffer. The market didn't give warnings over quarters. It delivered the verdict in hours. This is history's fastest reset in scale and velocity for precious metals. Bigger single-day or short-period wipeouts exist in pockets, like 1980 Silver Hunt Brothers Squeeze Unwind or 2013 Taper Tantrum, but nothing matches this $7 trillion evaporation in under 2 days. It's bigger than many entire bear markets in duration-adjusted terms. The 2008 equity crash took time to unfold its full damage. This precious metals event compressed equivalent, or greater, wealth destruction into a blink. That compression acts like a filter. It purges the unprepared ruthlessly while rewarding those who anticipated volatility, managed risk tightly, and held dry powder. The prepared didn't need months to react. They were already set. Contrarians who lightened up during euphoria, value accumulators waiting for overextensions, institutions with balanced books and cash reserves, they absorbed the supply when forced sellers dumped. No scramble, no emotion-driven errors. The speed punished hesitation and rewarded foresight. Those who understood leverage risks, who sized positions conservatively, who had rules for drawdowns, they didn't just survive, they capitalized. Lower prices meant better entry points for long-term theses that remain intact. Persistent supply constraints in mining, industrial silver demand from solar and electronics, central bank diversification away from dollars, geopolitical tensions that don't vanish overnight. In slow crises like 2008, many could pretend or adapt midway. Fast resets like this expose truths immediately. No hiding behind hope or gradual declines. The scared got flushed because they couldn't handle the pace. Their fear amplified the velocity. The prepared? They saw the same chaos as opportunity because they'd built systems immune to speed shocks. Discipline in sizing, patience in waiting, clarity in thesis. These traits shine brightest when events accelerate. This isn't about wishing for slow markets. It's recognizing that velocity is the ultimate test. 2008's months-long bleed let some limp through. This 36-hour sprint separated legends from casualties in record time. The reset happened so fast it cleared the field. Weak leverage gone, speculation purged, noise silenced. What remains is cleaner, sharper setups for those who stayed ready. History shows fast crashes transfer wealth quicker too, from panicked hands to steady ones. The prepared don't wait for permission or time to think. They're already positioned when the hammer falls. The speed of this wipeout wasn't random. It was the market's way of accelerating evolution. Slow bleeds allow mediocrity to linger. Rapid ones force adaptation or extinction. In precious metals right now, the fastest reset ever recorded has done exactly that. Rewarded the prepared with discounted assets and stronger relative positioning, while the scared paid the highest price for lack of readiness. Your net worth isn't the market's mood. It's your mindset, moves, and unbreakable resolve right now. Rise or get erased, choose. In the wake of that savage 36-hour wipeout, $7 trillion brolies. Shredded from precious metals, gold hammered down 13.6% below 4,900, silver obliterated 36% under $85, platinum and palladium dragged along in the carnage. The numbers on the screen scream one thing: devastation. Account balances shrink in real time, paper gains evaporate, leveraged dreams turn into margin call nightmares. People stare at their portfolios and feel their entire worth collapsing with the prices. The market's mood swings violently, and suddenly everyone believes their net worth is defined by those flickering red digits. Panic sets in because the ticker tape dictates value. Fear amplifies every tick lower, and the illusion takes hold. If the market tanks, so does who you are financially. But here's the unfiltered reality that separates those who crumble from those who rebuild. Your net worth isn't the market's mood, it's never been. The market is a manic beast, euphoric one day, terrified the next, but it doesn't own your core value. It can't touch the things that actually build lasting wealth. Your mindset, the moves you make under pressure, and the unbreakable resolve you forge in the fire. Those are internal assets. immune to daily fluctuations, compounding quietly even when everything external looks broken. Think about it raw. When gold was ripping to 5,600 and silver to 121 plus, the crowd felt invincible. Net worth ballooned on screens, lifestyles inflated, confidence skyrocketed. Then the reset hit. Kevin Warsh-fed nomination whispers, CME margin hikes, over-leveraged specs getting flushed, dollar surge flipping the script, and the mood inverted overnight. The same people who felt rich days earlier now felt poor, worthless, defeated. Their perceived net worth swung with sentiment because they outsourced it to price action. They let the market's volatility define their self-worth, their security, their future. The prepared don't play that game. Their net worth is anchored elsewhere. Mindset first, the mental framework that sees crashes not as endings, but as purges. They understand cycles. Euphoria breeds excess. Excess breeds correction. Correction breeds opportunity. They don't tie identity to highs or lows. They tie it to process. Discipline in sizing positions, refusing FOMO entries, building cash for dislocations. These aren't reactive, they're proactive architecture. When chaos arrives, mindset stays steady because it's built on principles, not prices. Then the moves, actual decisions in the moment. While the scared dump at bottoms to stop pain, the resolved act with clarity. They average in if the thesis holds, central bank demand intact, mining supply constrained, industrial silver needs from EVs and solar persisting, geopolitical risks simmering. They don't chase rebounds blindly, they scale methodically, protect capital, rotate into strength. These moves compound over time, turning temporary drawdowns into permanent advantages. A lower entry today means amplified returns when the cycle turns. The market's mood is noise, smart moves are signal. And unbreakable resolve, that's the glue. Resolve is what keeps you from selling low out of fear or buying high out of greed. It's the voice that says, this too shall pass, when adrenaline screams otherwise. It's cultivated through repetition, sticking to rules and small corrections, learning from past wipeouts, training the mind to detach emotion from execution. In this crash, resolve meant not liquidating physical holdings in panic, not closing futures at arbitrary stops, not scrolling doom feeds for validation. It meant recognizing the deleveraging for what it was, a violent but temporary flush of speculation, and staying positioned for the rebound setup. History proves this divide every cycle. In 2008, those who equated net worth with crashing stocks sold at lows and missed the multi-year bull. In 2020's COVID drop, panic sellers locked in losses while resolved holders captured the V-shaped recovery. Now, in precious metals' fastest reset, the pattern repeats. The market's mood shifted from euphoric to despairing in hours, but those whose net worth lived in mindset, moves, and resolve, they didn't just survive, they strengthened. Lower prices cleaned the field, purged weak leverage, created asymmetric upside for the steady. Right now, post-crash, the choice crystallizes. Let the market's mood dictate your story. Rise with rallies, crash with corrections, live in perpetual reaction, or claim ownership. Build mindset through study and reflection. Make deliberate moves, reassess allocations, hunt value in the wreckage, preserve dry powder. Forge resolve by recommitting to rules when temptation pulls. Your net worth isn't tethered to gold at $4,900 or silver at $80. It's expanded by how you think, act, and endure when the mood swings hardest. The market will mood swing again, higher, lower, sideways. It always does. But what endures is you, the decisions rooted in internal strength, not external chaos. Rise means choosing mindset over mood, moves over madness, resolve over reaction. Get erased means surrendering to the ticker, letting fear or greed write the next chapter. In this moment, after 7 trillion vanished in a blink, the real wealth transfer isn't just dollars changing hands. It's from those defined by markets to those who define themselves beyond them. $7 trillion gone in 36 hours. Weak hands burned, strong ones forged, fear exposed, discipline rewarded. The market didn't break you, it revealed you. Right now the choice is crystal clear. Stay scared and get erased, or rise with unbreakable resolve and claim what's next. This isn't the end of the story. This is where legends are born. If this hit you, if you felt that fire in your chest, then don't just watch from the sidelines. Take action, build, prepare. Become the one who buys the blood next time. And if you want more real-time alerts, no BS breakdowns, and the raw truth when the next move hits, hit that subscribe button right now on John AG Market Alert. Turn on notifications. Drop a comment below. I'm rising or locked in. Let me know you're in this fight with me. We don't chase hype. We build through chaos. See you on the next one. Stay sharp, stay disciplined,